I'm Sebastian St. James. This video will give you a superpower. What is the most important question to ask about a stock before investing in it? This is Debbie's lemonade stand. Oh, the first problem I notice, it's lemon with a little aid at the end. Can't you fit lemonade across your store? Debbie's lemonade stand is owned by Debbie and her sister Linda. She sells lemonade for 50 cents, right? Comes with a free straw and is guarded by Pants, the dog. Pants as in heavy breathing. Not the sort of pants that you should be wearing while you're watching my video. Well, they're fascinating facts about Debbie's lemonade stand. Debbie is looking for a $10,000 investment. Are you interested? Well, not yet. What's my second offer? Here is Jake's lemonade stand. Jake's lemonade stand is owned by Jake. This comes as no surprise to me. He makes a 50% profit. Well, that's a big surprise. Last year he made $3,000 in profit. This year he's up to $5,000 in profit. Oh, well done, Jake. I'm questioning this story. I mean, it sounds good. Obviously there are boys and girls selling lemonade right across the country. $5,000 from a lemonade stand, up from $3,000 last year. I wonder about that. Jake is also looking for a $10,000 investment. Are you interested? Possibly, but I need to compare both offers first. According to the Lemonade Weekly, the most trusted source of lemonade news, cute kids sell 30% more lemonade. So let's see who's the cutest. Well, this is Debbie and her sister. Yeah, definitely cute kids. This is Jake. Well, yeah, he's definitely a cute kid as well. So I'll give it 1 point to Debbie and 1 point to Jake. So far, neck and neck. But there is one more point I need to give out, and that is to Pants, the dog. Is he wearing some sort of yellow kerchief there? Oh, that's very cute. 1 point to Pants. Debbie cries on cue if you don't buy her lemonade. What? Well, look, that should increase sales, so I guess that'll be plus 1 point to Debbie. Interesting sales tactic, Debbie, but I want to know what sort of example you're setting for little girls across Australia. Jake gives you a free bit of gossip about the neighbours with each glass. Oh, wow. That is actually very tempting. I've always wanted to know what Kelly for number 14 and Dave for number 12 actually get up to. They've been spending a lot of time together, if you know what I mean. So, Jake, you've got yourself a deal. I'll buy a glass of lemonade if you give me the goss on that. So that is plus 1 point to Jake. Debbie has plans to expand her business to a second lemonade stand, interesting, which her sister Linda will run. Expansion plans are not a bad idea. That's how businesses grow after all. So plus 1 point to Debbie. Jake only has plans to run one stand. Okay, so no expansion, but he's increasing sales every year. Oh, okay, so totally different direction Jake is going. He's increasing sales, which has to have an extra point. So plus 1 point to Jake. This is an interesting twist. So Debbie is going to expand. We don't know how well she's doing in a one stand, but we do know that she wants to expand to a second. Jake, on the other hand, doesn't want to expand, but yeah, he is doing very well. He's growing his sales in the stand he's got. Debbie currently breaks even, but with her second stand, she hopes to double her sales. Break even means not making any profit. Okay, that's not good, particularly for a kid's lemonade stand. But once the second store opens, she'll be doubling her capacity. But if she's not already profitable in the one store, how will she be profitable in the two stores? I mean, we've got no example of the path to profitability. She doesn't state what that is. And therefore I'm giving her no points for that. We'll have to wait and see. Maybe expanding will work, maybe it won't. So for now, I'm not that impressed. Jake increased his profit by $2,000 from last year. Well, have a point, Jake. Well done. Debbie's second stand is going to be My Little Pony themed. What? I don't know if I can give you a point for that, Debbie. I mean, technically you're breaching somebody else's intellectual property. I mean, My Little Pony, do you have a license to brand your store as that? No, definitely you don't. On the other hand, the little girls may be much more excited to buy from you, but the adults who buy out of sympathy, are they going to be more attracted to a My Little Pony? Maybe not. I know I wouldn't be. So I'm going to say 0 points for you because I'm a bit on the fence about how useful that would be. Jake is going to grow his own lemons next year. Wow, increasing his profit by 50%. Yeah, I can see why. So plus 1 point to Jake, bringing him up to 5. Now we have all the facts. Let's do a comparison. Jake versus Debbie. Who will win? So far we know that Debbie is expanding to a second store. It's going to be a My Little Pony themed store, and at the moment she breaks even. Jake, on the other hand, his profits increased by $2,000 year over year, and his decreasing costs next year. Wow, okay, impressive. We can summarise that as being Debbie is expanding, she's exciting, and she breaks even. Jake, on the other hand, his profits increased and his decreasing costs. The question is, where am I going to invest my $10,000? With Jake or with Debbie? The comparison is really about unprofitable plus promises versus profitable plus growing profits. Yeah, it's beginning to be clearer to me all the time. If I go with Debbie, maybe she'll expand to a second store. Maybe her My Little Pony themed store will rock the lemonade world. And that's a sentence I never thought I'd be saying. On the other hand, if I go with Jake, he is profitable right now. And he's decreasing his costs for next year. So I can get a return on my money straight away. And he has a proven track record of profitability. Lemonade stands are one thing, but let's look at some Australian stocks and see what we think of them. As we've learned from our research into lemonade stores, yes, that's where I get all my wisdom from, lemonade stores, there are two types of businesses. So what are they? There's a profitable right now business that has a proven track record of profit. And there's the unprofitable business right now, but it has big dreams and no easy road to profitability. So Jake, you are going to be the recipient of my $10,000 investment into your lemonade store, but on one condition, and that is that you get Pants, which is Debbie's dog, to become a part of your lemonade empire. That kerchief, that's too cute. I cannot let that go. Here is a company that in the last few years has joined the ASX. As this is YouTube, there'll be certain words I will not be saying, but you can read them for yourself. Points is an ASX-listed sports operator and iGaming provider, offering innovative sports and race products and services direct to clients via its scalable, cloud-based technology platform. Oh, sounds exciting. Got a bit of promise there. Let's have a look at the financials. How much profit have you been making? Well, the answer is not a lot. We find their revenue has gone up from $194,000 up to $296,000, so they're definitely expanding. Ah, well done. But if we look at their profitability, their loss has gone from a loss of $187,000 to a loss of $267,000, which is up 43%. In the wrong direction. You don't want losses to go up. That's a terrible idea. Financially, this company's not doing very well. Now, sure, maybe it needs to have a bit of establishment time and it will grow over time. Not all companies are profitable from the year one. Personally, I say wait till you're profitable and come back to me because I don't know anything about you. Maybe you'll do well, maybe you'll fall in a heap. But right now, I'm not impressed. Bringing you the fastest experience in the world. And it's got some sort of American football player with a helmet, yeah. Let's see how much they're paying out. Not a lot, I suspect. The dividends paid is nil, and the proposed amount is nil. Oh. But then again, it's a new company. They're not profitable, of course. They're not going to pay out dividends yet. But I'm seeing different things that are lining up, and I'm becoming less impressed over time. Dear shareholders, it has been another successful years for Points. Successful by what measurement? By expanding. That is where the success comes. By profit, no. Not so much. During the year, the company continued to capitalize on its expanding US presence by scaling its operations through key hires across all departments, as well as rolling out sports operations in 4 new US states. Wow! Well, that sounds exciting. They're expanding. Good luck to you. But on the other hand, I read 3 unprofitable companies booted from the ASX 200. So who are they? Life 360, Points, and Zip. Right. Well, I think they're big on promises. Well, they are expanding. That's interesting, but they're not profitable at this point. There's one important piece of information that you need to know that will save you from a lot of heartache. When Billy wants a dog and says he'll look after it and take it for a walk every day, he won't. He'll become lazy and you'll end up doing all the walking. So be warned. Now I've given you that hot tip. Here is something you need to know about companies. Profitable companies don't go broke. I mean, why would they? They're profitable. Unprofitable companies can go out of business. This is key. Sure, you can invest in unprofitable companies, but you are taking on extra risks by doing it. So just by excluding companies which are not profitable at the moment, which have not been consistently profitable over the last few years, you can actually de-risk your portfolio. While profitable companies have a close to zero chance of going bust, Unprofitable companies, we don't know. We don't know what their percentage chance of going bust is. It could be 50%, it could be 90%, it could be 10%. It just depends on the company in particular. But unprofitable companies are not necessarily allowed to run forever as unprofitable. Someday, some major shareholder is going to call enough is enough, put the brakes on, and that will be the end of the company. Do you want that risk in your portfolio? Well, that's something you need to decide. Let's take a look at some companies which are on the ASX right now that are profitable right now. But I'm going to take it to a whole new level. I'm going to say not only do you need to be profitable, but you need to be increasing your profit year after year. A high bar for sure, but that is what we're going to look at. But first, we need one new skill, EPS. What does that stand for? Well, that is earnings per share. Earnings per share is a really simple calculation. How much profit have you made? That's the earnings part. How many shares do you have outstanding? That's the shares part. Divide the two and now you have earnings per share, which is in dollars or cents. Depends on how badly you've been doing. Pop quiz. I'm going to present you with two companies and you need to provide me with an answer. Which is the better company? Company A has an EPS of $2, that's $2 per share. Company B has an EPS of $4. Interesting, that's twice as much. So, which is the better company? I'll give you 5 seconds. And the answer is... I have no idea. There's not enough information to tell me anything. EPS on their own is totally meaningless. Company A has this EPS, Company B has this EPS. I will show you why EPS is meaningless. Company A has earned $1 million. Oh, that's impressive. It has 500,000 shares outstanding, therefore the EPS is the profit, which is $1 million, divided by the number of shares, which is $2 per share. Now, Company A decides to go through a reverse stock split, a 1-for-4. What's a reverse stock split? Well, what's a stock split to start with? A stock split is where you actually increase the number of shares. So maybe you'll get 4 shares for every one you've got. That is a stock split. A reverse stock split is the other way around. Why would companies do a reverse stock split? It's because their shares are getting too low in price. So if your shares are now penny stocks, all you need to do is do a reverse stock split and they're not penny stock anymore. It's like magic. So Company A does a reverse stock split of 1-for-4, which means the number of shares it has outstanding is now 125,000. Straight away, the earnings per share is now $8 because there are fewer shares outstanding. Has the company become more profitable? The answer is no. Has the EPS gone up? The answer is yes. Back to our original question. Company A, which now has an EPS of $8 because of its reverse stock split, and Company B still has an EPS of $4, which is the better company. Well, as you can see, EPS is totally meaningless. It doesn't tell me anything other than it means the company's profitable. It means it's got some earnings. So that's a good thing. But the actual number, how many shares do you have outstanding? That's what I need to know. So why use EPS? Trends in EPS can be very meaningful. So let's take a look at that. Here are two companies, ABC and DEF, yes? This year, they both earned $2 per share. Last year, it was $1.90. Okay, they've come up. In 2020, ABC earned $2.20, actually higher than this year. Interesting. DF earned $1.80. Okay, so they've come up. In 2019, ABC earned $2.10, which is actually higher than it is today. That's not good. And DF is up from $1.70. Aha. So, although EPS on its own is meaningless, the growth in EPS is very meaningful. Let's put our brand new skill that we've just learned, that profitability is important, to use on the ASX. If I've got $10,000 right now, which companies would I invest in? First of all, out of all the stocks on the ASX, I need a screening mechanism. What am I going to look like to narrow down those stocks? Well, this video is all about profit, so let's start there. Requirement number 1 is 1 year earnings per share growth of greater than 10%. Well, that's not bad. 10% growth year over year in earnings. That's not an impossible bar to jump over, but it's certainly a reasonable bar, and that will exclude a lot of companies. So let's see what that gives us. And here they are, straight off the ASX. This is live as we speak. Anno, which is Advanced Zinc Limited. In the materials sector, it has a growth for 1 year of 7,060%. Wow, that is very impressive. CEL, Challenger Exploration Limited. In the energy sector, has a 1 year growth of 3,225%. Yeah. BOE, Boss Energy, has a growth this year of 2,920%, and so on down the list. This is super interesting to me. This is real growth. This is profit. This is not just projected, I would like to grow my company, wishy-washy dreams. This is actually earnings per share growth, but I need more. So we're going to look for companies which have a 5-year average earning per share growth of 10%. Is that 10% over the 5 years, or is that 10% year over year? That's 10% on average year over year, which is pretty good. And here's the list that's generated on that. We have SSR Mining in the materials sector, and it has a 5-year growth of 208%. Yeah, that's impressive. Iluka Resources has a 5-year growth of 143.5%. Horizon Oil Ltd in energy, a 5-year growth of 132.3%. This is amazing. This is stellar growth over a 5-year period. Consistent? Oh, that part we don't know. This could be all the growth has happened in the last year. Perhaps there were some losses before that. But if you divide the growth over the last 5 years, then it gets a good, nice, healthy profit. Or has it been growing consistent year over year? That we would need to dive in to see. Oh, a new requirement. Over the 10 years, the average EPS growth has to be 10%. Again, wow, there'll be no shares left. What I'm trying to tease out is to get consistent growth over a long period of time. Depending on what type of investor you are, adding a 10-year requirement actually may screen out a whole lot of new, say, tech businesses that have only been around for 7, 8, or even 9 years, but you haven't been around for 10, therefore we exclude you. So that's a risk. On the other hand, if you're a little bit more conservative, requiring a company to be around for 10 years is a no-brainer. Of course, I need to see consistent growth over time. I need a proper track record. So here are the shares, sorted by earnings per share over 10 years. So I'm not stock picking here. These are purely the results of our stock screens. And then we'll have a look at the individual stocks to see whether we actually like them or not. This first one is CD2, which is the CD Private Equity Fund II. The sector is ASX internal. What does that mean? Generally speaking, companies that invest in other companies get an ASX internal code because what is their business? Well, investing in other stocks, right? So that's where that comes from. Over the 1 year, it has 3,044%. Wow. Over 5 years, it's had 29.5%, and over 10 years, it's had 106.9%, which is the highest stock. Next is GCX Metals Ltd in energy. Its 1 year growth, 14,000. Its 5-year growth, 123. Its 10-year growth is 67. Bathurst Resources is in material, 127, 95, 52. Still impressive. CIA Champion Oil is 15%, 85, 47. And Whitehaven Coal is 2,000%, 36 and 47. Yeah, impressive for sure. But that's based on a stock screen. We are looking for companies which are generating profit year after year. I think we may have found some. But remember, these are averages. Averages over 10 years. Averages over 5 years. We need to look into the stock a little bit closer to see if those profits are actually consistent or not. CD Private Equity Fund II, formerly called Cordish Dixon Private Equity Fund II. Has been established to provide unit holders with the opportunity to benefit from a family office style of investment focused on small and mid-market private investment opportunities in the US. Walsh & Company Investment Limited is the responsible entity of the fund. It has a market cap of 61 million, which is rather small. Just to give you a sense of that, anything under 100 million, which is still pretty small, 100 million, some people consider not to be particularly investable. Obviously it is, you can buy their shares, but you are getting down at 61 million. Its returns over the 1 year has been 4%, while the stock market in general has gone down quite a bit, so Over the 3 years, 11%. Over 5 years, 9.5%. Nothing too bad, nothing that shocks me, but nothing that impresses me either. That's sort of a bit neutral on that. Let's jump into the per share statistics. In 2013, it was minus 0.1 cents per share. The next year, they made a profit of 13. Good. Next year, they made a profit of 54. Next year, they made a loss of 4.3. Yeah, that's not impressive. Then they're up to 11, so nowhere near as high as their 54. Up to 20.6. Up to 44.5, but now down to 38.8, and then down to minus 1.4. And then back up to 41.5. This is an absolute roller coaster. Sure, overall, over long periods of time, they've got a good return, a good earnings growth. But for me personally, this is far, far too unreliable. This is a small company, so inherently unstable, and their profitability has been up, down, up, down, up, down. Profit, profit, loss, loss, profit, profit, loss, loss. GCX Metals Ltd, formerly Paringa Resources Ltd, is a US-based energy provider developing the Buck Creek mining complex located in the growing Illinois coal basin. The company has also entered into an agreement to increase its gold-copper footprint in the Pilbara region of Western Australia by acquiring 80% interest in granted exploration license E08/3197. What? That is awfully specific. Located adjacent to the company's Onslow Gold project. This to me is super weird. If this was an announcement that the company just put out, oh, we have an 80% interest in this particular lot, here's its particular number, I'd say fair enough, that's your announcement. It's brand new. But that's not what we're looking at here. This is a description made by the company itself. Remember, companies get to write their own description. I'm sure the ASX has some rules about what they can write, but essentially this is penned by the company itself as an overall description of what it does. I mean, you've read the other descriptions. Oh, we do a bit of coal, or we are in this company. Broad statements overall. Not for this company. In their company statement, they actually mention this specific license holding. I think that does tell me something about the company. Let's jump in and have a look. In 2013, its earnings was -1. The next year they were worse. And suddenly, in 2020, they jump up to 26.6. Wow, that is a big jump. But in 21, though, they go back into debt at -1.3 cents per share. And in 2022, 195.8. For my money, that sounds too much like a once-off. They're not consistent in their earnings. Bathurst Resources Ltd, BRL, is involved in the production of coal in New Zealand and the exploration and development of coal mining assets in New Zealand. If we have a look at its stats, in 2013 there was a loss of 0.4. Next year, massive loss, -376.2. Now they've started to turn around at -13, -1, -6, good, up to 5. Next year was 24.6, woo, down to 7.9. What's happened there from 24? Down again slightly in 2021 and then slightly up in 2022. To me, it sounds, as far as profitability is concerned, they are struggling a bit. They're not consistent. Too many roller coaster rides. Champion Iron Ltd, CIA, formerly Mamba Minerals Ltd, is an iron development and exploration company focused on developing its significant iron resources in the south end of Labrador Trough and in the province of Quebec. Their flagship projects are Bloom Lake and Fire Lake project. Bloom Lake and Fire Lake. I'm excited just reading that description, but let's take a further look. Their market cap is 2.5 billion, so they're not a small company. Their earnings in 2013 start off negative. The next year they go worse. They're starting to pull it back in 2015. Pulling it back, no, back to -5. Oh, down to -18. And suddenly they're positive, 19.4. Next year, 21.7, 95.9, and 110.4. This sort of earning pattern actually doesn't really concern me because I expect companies to be unprofitable when they first start off. So if I see unprofitable, profitable, getting more, then that's fine. Even if it's only a few years of profitability, it looks to me as if this company now has got its business model locked in and their profitability is rising year after year, although it's only the last few years. But yeah, so far I'm okay with that. Its total shareholder return over the 1 year is 18.7. Given what the market's been doing, that's impressive. Over 3 years, 33.3. Remember, that is an average annual and not for the entire 3 years. Over 5 years is 97. Yeah, 10 years, 34. I'm loving this. I'm loving the whole thing, basically. I'm loving their returns. But what's their future like? Well, let's take a look. Well, their earnings are certainly going very well, 47, 85, 15. But next year, this is interesting. The forecast for the next 2 years is -10.3. So they are expected to dip a bit in their profit. Interesting. But let's see what their performance has actually been. Let's take a look at their graphs. Over the 1 year, we find CIA is in the red and green. VAS is an ETF that you can invest in. So we'll compare it with that. And the company's been going up, 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 up. A big crash down, I'm noticing that, but it does end over the 1 year higher than the ASX or the ASX 300. Over the 5 years, which is a reasonable period of time. We notice they're matching VAS, and then they break out and go above, and up. Yeah, they've done so much better than the market overall. Our last stock is Whitehaven Coal, WHC. It's an Australian producer of premium quality coal focused on development and operation of coal mines in New South Wales and Queensland. Their market cap is, well, it's $9 billion. Their return over the 1 year has been 340%. Wow! Over 3 years, 50. Over 5 years, 28. Over 10 years, 16.8. They're all up. I love them. If we look at their earnings, however, in 2013, -6, then -2. Oh, now we're in profitability. 0.1, 2.1, 41.1, going in the right direction. 52, yeah, 52. I'm loving this. Oh, something's happened in 2020. Down to 3. Oh, we've lost the plot. The cart is off the track. -8 and then up to 195.1. Wow, they're all over the place. Their earnings going forward. 10 years has been 47.8, 36, and then 2,327.2. That's impressive. Importantly, their earnings through the next 2 years is supposed to go up by 54.7%. Lots of things to love there. Let's look at their graph and see how they've done. Over the 1 year in red and green, Whitehaven Coal has gone up, 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 up. Yeah, beautiful, perfect. Over the 5 years, however, they've been in and out. Yes, we can see that tumultuous past. They've beaten VAS, then they've lagged for a couple of years, and then they've finally beaten them overall. So let's have a look at my breakdown. The question you need to ask yourself about white coal is there an energy shortage at the moment? Yes, absolutely there is. Are power prices, which are very much dependent on coal, skyrocketing? Yes, they are, absolutely. Are renewables threatening coal? Well, yes, they are. But until they get storage, which is batteries, sorted out, baseload coal will always play a big part. The energy market has gone through quite a pivot lately. Up until, say, a year or two ago, coal was being phased out. In Australia, we know there's a lot of coal power plants which are actually being decommissioned. Why? Well, because it's a dirty type of fuel. Australia in general is slowly moving towards renewables, and therefore coal is on the way out. But hang on, there are some things going overseas. There's some crises. Gas prices have shot up. Coal prices have shot up. Energy prices have shot up. And therefore, we need as much cheap energy as possible. What's cheap in energy? Oh, coal. That's right. Let's grab onto that again. So coal lately has had a bit of a resurgence. I think over the next few years, you'll probably be right with coal because of the energy crisis. But if you go 10 years into the future, 20 years into the future, I think it will reverse and renewables will come back into vogue. But where's the list? You need to have the list, and here it is. There are plenty of stocks for you to go through, and you see the profitability of each of the stocks. So, happy hunting. In this video, we talked about earnings, a very important topic. But what are the best dividend stocks for Australian retirement right now? Click here to find out.